No fluff, no preamble. Brent Crude just hit $113.97. That's a $5.19 jump in one session. 4.77% in a single day. And this isn't some random blip. It's the market finally waking up to a supply crisis. I am Eric FRO Alpha Market Meridian. Goldman Sachs estimates the daily supply loss at 14.5 million barrels. Let that sink in. 15% of global oil production, gone, offline, and not coming back anytime soon. If you've traded oil for more than 5 minutes, you know that number is mind-blowing. The 2022 Russian invasion of Ukraine barely touched physical supply by comparison. What's happening right now in the Strait of Hormuz? It's multiple times worse, and the price chart is only just starting to catch up. Today, I'm breaking this down for you. Exactly what's on the 4-hour, daily, and weekly charts, the critical levels you need to watch right now, and most importantly, 3 trade setups. Conservative, standard, aggressive, each with exact entries, exact stops, and exact targets. If you're new here, I cover 8 key assets every single day with institutional-grade analysis. Hit subscribe and that notification bell now, because tomorrow, this market could look completely different, and you don't want to miss it. The verdict: let's get straight to it. Brent Crude is in a powerful bullish trend across all 3 timeframes I track. This isn't up for debate. The 4-hour chart. Prices are rock solid above every major moving average. The daily chart confirms the breakout structure. And the weekly chart. I'll show you in detail. It's making a move we haven't seen since early 2022, but here's where it gets dangerous for the unprepared. The market is overbought on multiple oscillators and fundamentally underpriced relative to the physical market. That tension, between overbought technicals and a supply panic that's justified, this is where fortunes are made, and loss.my base case, the trend is higher. But the path there? Violent, two-way, and unforgiving. Your job isn't to predict the top. Your job is to manage the ride. Today's bull-bear line is $110.75. Above that level, the trend structure stays intact. Dips are for buying. Below that level, and I mean a daily close below it, not an intraday blip, the breakout story starts to fall apart, and we could see a fast drop to $106.50. Technical deep dive. Pull up your charts. Let me walk you through what's on your screen right now. Open your 4-hour chart. You'll see the session opened at $108.11, hit a low of $106.51, then exploded to a high of $115.21 before settling near $113.97. That's a $9 range in one session, roughly 8.5% from low to high. This isn't normal volatility. This is a market under severe geopolitical stress. Now, look at your moving averages on the 4-hour time frame. MA5 is at $112.62, MA10 at $110.74, MA20 at $110.95, MA40 at $107.53. Every single one is sloping higher. More importantly, price is trading above all of them. That's textbook bullish alignment. No gray area, no ambiguity. Short term. Average above medium term, medium above longer term, and price above everything. Bulls are in total control here. Drop down to your indicators. 4-hour MACD is 0.32, positive, above the zero line, and above its signal line. Histogram bars are green and expanding. That's momentum accelerating, not slowing down. RSI is 71.66, overbought. But here's what disciplined traders need to know. In a strong trend, overbought can stay overbought for weeks. The RSI isn't telling you to sell, it's telling you the trend is rock solid. KDJ is 97.83, extremely high, but again, it's a measure of trend strength, not an automatic sell signal. Now pull up your daily chart. That's where the bigger picture comes into focus. Daily MA5 is $109.93, MA10 at $106.51, MA20 at $101.48, MA40 at $102.26. Notice anything? MA20 and MA40 have already crossed, shorter above longer, and MA10 is accelerating into that structure. That's a golden cross in the works. Daily MACD is 2.11, positive, strong, still expanding. Daily RSI is 70.32, overbought, yes, but in a supply shock trend? That reading could easily hit 80 or 85 before any real correction. The daily chart also tells you about the structure of this move. Look at price action since late February. Market bottomed near $65, consolidated through March between roughly $90 and $105, and now has broken decisively above that range. This is classic impulse correction impulse. The measured move target from that consolidation range? Roughly $120 to $125. We are not there yet. Now step back to the weekly chart, and this is where it gets remarkable. Weekly MA5 is $114.14, MA10 at $112.74, MA20 at $110.66, MA40 at $110.28. The moving averages are compressed into a super tight band between $110 and $114. When moving averages compress like this and price breaks above, it usually leads to a violent directional move. The weekly trend indicator is flashing bearish, don't ignore that, but that's just shorter-term averages playing catch-up to price. Weekly MACD is positive, and the weekly structure is a breakout. Key takeaway from the technicals: support is clear at $110.75. That's where the daily MA20 and the bottom of the 4-hour moving average band meet. Below that, $106.51 is critical secondary support. That was today's low, and it lines up with the daily MA10. On the resistance side, $115.21 is the immediate barrier, today's high. Above that, $120.51 is the next structural level on the weekly chart, and beyond that, $125 is the psychological and measured move target. Goldman Sachs and other big desks are highlighting fundamental drivers. Why today happened? Let's connect the news to the price action. Because understanding why the market is moving is just as important as knowing the levels. Sunday, May 3rd. OPEC Plus held its first meeting since the UAE formally exited on May 1st. 7 core members, Saudi Arabia, Russia, Iraq, Kuwait, Kazakhstan, Algeria, Oman, agreed to raise June production targets by 188,000 barrels per day. Third consecutive monthly increase. On paper, more supply should be bearish. But the market rallied right through it. Why? Because the Strait of Hormuz is effectively closed, and the countries that would increase production, Saudi, Iraq, Kuwait, can't physically export their crude. Saudi's June quota is 10.29 million barrels per day. Its actual March production, per OPEC's own data, 7.76 million barrels per day. That's a 2.5 million barrel per day gap, just for Saudi. Multiple OPEC Plus sources and analysts call this production increase mostly symbolic. Risted Energy's Jorge Leon, former OPEC official, called it a dual signal. Continuity after the UAE's exit, and a show of control even when the practical impact is minimal. The market gets it. 188,000 barrels per day of theoretical supply is nothing against a 14.5 million barrel daily shortfall. Then Monday, May 4th, the session we are analyzing, the situation escalated. Iranian state media, Fast News Agency, claimed 2 missiles hit a U.S. warship near Jask Island that ignored Revolutionary Guard warnings. U.S. Central Command denied it outright. No U.S. ships hit. The UAE clarified. An ADNOC-affiliated tanker was struck by Iranian drones. No injuries, but the damage to market sentiment was done. Brent exploded from below $108 to above $115 in hours. Haiti. The same time, President Trump announced Project Freedom, a U.S.-led initiative to guide stranded vessels through the Strait of Hormuz. 2 U.S.-flagged merchant vessels transited successfully under military escort. That's positive. But it's also a reminder of how disrupted normal shipping is. The hit vessel was an oil tanker. Infrastructure at Fujairah, a critical UAE oil hub, was targeted and caught fire. These are the first major infrastructure strikes in weeks. The escalation is ramping up. What most traders are missing, and what you need to internalize, is that the oil market has split into two parallel pricing universes. The futures screen you're watching, Brent at $113.97, is the paper market. The physical market, where actual barrels change hands between producers, traders, and refiners, is way tighter. Saudi Aramco is charging European customers record premiums over Brent for Arab light crude. Refiners are desperate for immediately available cargoes. In the spot market, North Sea dated crude, the closest to physical Brent, was reportedly trading around $130 per barrel, roughly $60 above pre-conflict levels. And that's before freight and insurance, which have skyrocketed due to Gulf War risk. The IEA's April oil market report was the most sobering assessment from any major institution. Global oil supply plummeted by 10.1 million barrels per day in March to 97 million barrels per day, the biggest single-month disruption ever. OPEC Plus production alone fell 9.4 million barrels per day month-over-month. The IEA also slashed its 2026 demand forecast from 730,000 barrels per day growth to an 80,000 barrel per day contraction. That's an 810,000 barrel swing in 1 month. This is demand destruction, caused by scarcity and sky-high prices, and it's spreading from the Middle East and Asia-Pacific outward. But even with demand destruction, the supply-demand imbalance is catastrophic. The World Bank's April commodity markets outlook projects, even if the Middle East supply disruption ends in May, global energy prices will surge 24% in 2026. In a severe scenario, Brent could average $115 per barrel this year. We are already their .1 variable most traders neglect: speculative positioning. CFTC's Commitments of Traders report, week ending April 28, shows WTI crude speculative net long positions fell by 3,416 contracts to 108,498. Speculators are reducing bullish bets even as price climbs. That creates a powerful dynamic. If price keeps rising, these underpositioned speculators will be forced to chase, adding fuel to the rally. Classic setup for a short squeeze, even in a market that's already up big. The IEA also warned, the only way to ease pressure on supplies, prices, and the global economy is to reopen the Strait of Hormuz. Iran's May 3 ceasefire proposal includes a phased approach: 30-day ceasefire to full truce, international mechanisms to prevent hostilities, gradual strait reopening tied to lifting port blockades, and Iran handling mine clearance. President Trump called the proposal unacceptable as is. Negotiations are fragile. The market is pricing in zero chance of a near-term resolution, and given the track record, that's probably right. 1 to 2 week outlook, I expect continued upward pressure with violent intraday swings. The physical shortage is real. The paper market is still catching up. OPEC Plus's production increase means nothing if the strait stays disrupted. The only risk to this view? A real breakthrough in ceasefire talks with verifiable steps to reopen the strait. If that happens, expect a sharp, $15 to $20 intraday correction as the risk premium collapses. But until then, the path of least resistance is higher trade setups, 3 strategies, exact levels. All right, this is what most of you are here for. 3 trade setups, tailored to different risk profiles. Every setup has precise entry conditions, exact stop losses, exact targets, and the logic behind them. Do not skip the risk management section after this. Strategy 1, the conservative pullback play, high probability, smaller size. This is for traders who want to join the trend without chasing overbought levels. You wait for the market to come to you, not the other way around. Entry condition: wait for a pullback to the $110.75 to $111.50 zone. This is where the daily MA20, 4-hour MA10, and today's value area low meet. Don't enter blindly. You need a confirmation signal, a bullish engulfing candle on the 15-minute chart, a MACD cross above zero on the 15-minute, or a bounce that holds above $110.75 for at least 2 straight 15-minute candles. No confirmation, no trade. Patience is your edge here. Stop loss. Place it at $109.40. That's below today's value area low and there. Psychological $110 handle, gives the trade room to breathe, but protects against a structural breakdown. If price closes below $110.75 on the 4-hour chart, the setup is invalid. Exit immediately. Target 1. $114.50, just above current price, near today's high. Risk-to-reward ratio, roughly 1 to 1.5. Target 2. $118. Next structural resistance on the daily chart, aligns with Fibonacci extensions from the March-April consolidation. At this level, take 60 to 70% profit and move your stop to break even on the rest. Invalidation. A daily close below $110 voids this setup. Take the small loss and wait for the next opportunity. The market always gives another. Strategy 2. The standard momentum continuation, balanced risk to reward. This setup assumes momentum continues and today's high, $115.21, gets tested and broken. You enter on a confirmed breakout, not a pullback. Entry condition. Wait for a 30-minute candle close above $115.50. That's above today's high. Confirms sellers they have been absorbed, and buyers are in control. Don't enter on the first tick above $115.21. You need the candle close to avoid false breakouts. Alternative entry. If price pulls back to $113 to $113.50, 4-hour MA5, and holds with a bullish 15-minute MACD cross, enter there with a tighter stop loss. On the breakout entry, place at $113, below the breakout point and 4-hour MA5. On the pullback entry, place at $111.40, just below the 4-hour MA10. Logic. If the moving averages defining the short term. Trend break. The momentum thesis is wrong. Exit. Target 1. $118. Same structural level as the conservative setup, start of the daily measured move. Target 2. $120.50. Major weekly resistance, upper boundary of the current weekly range. Target 3. For runners only $124 to $125, full measured move target. Aligns with Goldman Sachs projection if the straight disruption persists. Move stop to break even once target 1 is hit. Trail stop by $2 behind price on the rest. Locks in profits while letting you capture an extended move. Invalidation. 30-minute close back below $113 cancels the breakout entry. Daily close below $110.75 cancels the pullback entry. Respect your stops. The market doesn't care about your opinion. Strategy 3. The aggressive fade, high risk, professional only. Let me be clear. This is for experienced traders with high risk tolerance. You're fading an extreme intraday move. Success probability on any single fade in this strong trend is low. But the reward is asymmetric. When it works, the payoff is huge. This is not for your core capital. Entry condition. Wait for a spike to $118.50 to $120, confirmed by bearish divergence on the 15-minute RSI. Price makes higher high, RSI makes lower high. Also, look for a bearish engulfing or shooting star on the 15-minute chart. Both conditions must be met. Don't fade just because a number looks high. Stop loss. Place at $121.50, above the $120 psychological level and weekly resistance. Tight stop by design. Counter trend. Trades need quick exits if you're wrong. Target 1. $114. Rapid retracement to the value area and 4-hour MA5. Target 2. $111. Deeper correction to fill the gap toward the daily support zone. This setup targets $5 to $7 profit per barrel versus $2 to $3 risk. Risk to reward over 2:1. But win rate on countertrend trades in a supply shock bull market is low. Size accordingly. Half your normal position, or less. If you can't handle losing 3 to 4 of these in a row, don't take this trade. The risk management bell. This is non-negotiable. I say this every video, and I'll keep saying it until every trader gets it. Your biggest edge is survival. Not your entry. Not your indicator. Your ability to stay in the game. Never risk more than 1 to 2% of your total trading capital on any single trade. With crude's volatility right now, calibrate your position size carefully. If your stop is $2 away and you're trading a standard 1,000 barrel Brent contract, that's $2,000 risk. Make sure that fits your parameters. If not, trade smaller contracts or use CFDs with flexible lot sizing. Don't hold positions into major news. The next OPEC Plus meeting is June 7th. Before that, any Iran-US negotiation development, a ceasefire, straight reopening progress, could trigger a $15 to $20 intraday reversal. You don't want to be on the wrong side with a full position. A stop loss is not a suggestion. You don't widen it when the market goes against you. It's the price where your trade thesis is proven wrong. Hit that price? Exit. No questions, no hesitation, no hoping. Traders who blow up accounts move their stops. Traders who compound capital honor them. Wrap up tomorrow's focus, and your call to action. Here's what you need to remember from today. Brent at $113.97, up 4.77%. Support at $110.75 and $106.51. Resistance at $115.21, $118, and $120.51. The trend is your friend until a daily close below $110.75. Tomorrow, I'm watching two things. First, follow through on the U.S. Strait escort operation. More successful transits could ease supply panic, modestly. Second, the response to Iran's ceasefire proposal. Progress. Sharp risk premium unwind. Collapse. The opposite. The June 7th OPEC Plus meeting is coming, and I'll cover every development. Now, I want to hear from you, bullish or bearish on Brent from here. Drop your personal bull-bear line in the comments, the price that would change your mind. Mine is $110.75. What's yours? If this breakdown helped you understand today's oil market, smash that like button. It tells the algorithm to show this to more traders who need it. Subscribe and hit the notification bell if you haven't already. I release 8 asset-specific videos daily. Forex, commodities, indices, crypto. Don't be the trader who catches the move 24 hours late. This is the Alpha Market Meridian. Trade the data. Respect the risk. I'll see you tomorrow.